What's your biggest fear right now for the U.S. economy?
Well, I have several, Todd. The top 1% of earners have more wealth than the entire middle class. That has never happened before in history. And that's not a function of free market capitalism. This is the hollowing out, the destruction of the middle class. And then, of course, you have the housing bubble. You look at home price to income ratios, they've really never been higher. Home price affordability is the lowest it's ever been. There's no way you can have a housing market stay where it is when you have first-time home buyers priced out of the market. They just can't afford a house. It's a cycle it's doomed. It has to correct. Home prices have to correct by 30 to 40%. Equity prices have to correct by 50% just to put them back into historical normal metrics. That's going to render a lot of banks insolvent. If there's a problem in the debt markets and the credit markets and in real estate and in stocks, I can't imagine there's going to be a lot of banks out there healthy and making loans because they won't have any capital. The functionality of the banking system, the shadow banking system, corporation, it all exists on the proper greasing and oiling of money markets. When they freeze, you're talking about a depression on steroids.
Michael Pinto, welcome to the show.
Thanks for having me on, Todd.
You are the president and founder of Pinto Portfolio Strategies. You produce your own podcast called the Midweek Reality Check, and you're an author. You wrote the book called The Coming Bond Market Collapse and How to Survive the Demise of the U.S. Debt Market. Michael, it's an absolute honor to bring you on to our show. I have so many questions, but before we get started, I've never heard you. I've heard a lot of your podcasts. You've been on my friend's show, Adam Taggart, quite a bit, and I've listened to you and other podcasters as well. But I never hear you talk about who you are and like what it was like growing up for you and how you kind of what your influences were and how you got into the business of finance. So take us back. Can you tell us who is Michael Pinto?
Wow. Well, you're going to take the whole hour or 45 minutes talking about me. Why would anybody be bored enough to want to know about me?
Well,
let's see. Why? I'll just mention why I got interested in finance. I used to watch something with my father it was CNN FNN. And they just would have like numbers going across the bottom of the screen. I used to hate it. I said, "What, Dad, can I just put on something else? Why are you doing this? What for?" And it was then, and I was a rather young man at the time. I'm 61 now, but I was rather young at the time. And it enlightened me to the fact that you could actually make money and then invest it and the money would work for you. Beyond, of course, I knew you could put money in a bank and you make interest, but you could buy a stock and that stock could go up and you can make money. I was just fascinated by that. It was like a, epiphany for me. So I guess I was hooked from that point on. And I got in the business in 1991 as a registered professional. I worked on the floor of the New York Stock Exchange for several years, and then I opened my own business. I used to work for Euro Pacific Capital, Delta Global. I was a senior market strategist in both those firms. And then I opened my own shop in 2012. By the way, did I mention that I was thrown off every major financial, almost every one? Newsmax has me as a contributor.
You were thrown off. You were
thrown off. Persona non grata. Because I don't know exactly what it was. There's so many things not to like about me, but I did have a habit of just telling people the truth and how I really felt. And that, as a matter of fact, I'm probably best known for calling the Federal Reserve a serial counterfeiter. And they counterfeit base money supply, which is even worse than counterfeiting what Al Capone did. They counterfeit Fed credit. So I don't think they like that too much.
Well, how were you always that way when you were a young man? Were you one that always spoke your mind and kind of told what you thought or what your opinions were? And how did that go for you back then?
Yeah, I guess for the most part, and that's why people just generally don't like me.
Well, I don't believe that. I don't think that's true. But, I could tell you my grandmother used to say to me all the time when I was growing up, must you say everything that you think? Do you have to actually, speak it? Can you just like not say it?
I'm actually in truth not like that on my personal life, probably more close to the opposite. But when it comes to this and the venues like this, I guess God gives you a purpose in life, and you like to think that you're doing His will. And I think, to be honest with you, we don't have much time on this earth, and what you could do, perhaps, to persuade people to do the right thing, and given a certain, semi-famous kind of platform, you got to do what you have to do. You have to do the best you can. So, for example, before I was thrown off CNBS, I was on twice a week for many years, 2006, 2007, 2008. As a Cassandra, they needed a straw man to say, something negative about the economy. And I was warning about the housing market. And perhaps, maybe I saved some people's retirements by getting them out before, when it really became salient in October of 2008. And now I'm warning. By the way, I have a long short strategy. Sometimes I'm long the market, long and strong, and sometimes I'm short the market. And I own stocks, bonds, commodities, currencies. So I look at things. I have a model called the inflation, deflation, and economic cycle model. It looks at the second derivative of inflation in the context of economic growth. And in that way, it allows me to participate in bubbles when they're blowing up, and then gets me out of harm's way, me and my clients out of harm's way when they unravel. And we're close to having another one of those episodes. Todd, the average recession, I think it's down 37% on the S&P 500. That's the average recession. And if you look at the 2000 recession, NASDAQ bubble collapse, if you look at the 2008 global financial crisis, the S&P dropped 50%. And the carnage was even worse in the NASDAQ in between 2001 and March of 2000 and 2003. They lost 83%. Home prices dropped 33% in the global financial crisis. So, there are times when you should just passively buy and hold stocks. This is not one of those times.
Well, what's your biggest fear right now? I mean, there's a lot of volatility. I mean, what's your biggest concern for the U.S. economy?
Well, I have several, Todd. First of all, for the first time in history, we have a triumvirate of asset bubbles. We have a massive stock bubble still, even though the market's down. I think the S&P's down. Depends last time you look. It bounces around a lot, but it's down about 15%. And even though it's down, it still represents one of the most expensive stock markets in history. And if you look at the price to sales ratio, if you look at total market cap of equities to GDP, it's still in the thermosphere of valuations. You look at Shiller PE ratio, and then of course you have the housing bubble. You look at home price to income ratios; they've really never been higher. That's the best metric to judge a home price. Is not just that it went up. What's the home price to income ratio? It's just still through the roof. Historically, much higher than it was even in 2005. And then you look at the cost of owning a home, which includes the insurance and taxes. It's the lowest it's ever, home price affordability is the lowest it's ever been. And then you have a credit bubble. Now, and Todd, what else would you expect? You would expect an equity bubble. You would expect a bond bubble, and you would expect a housing bubble when real interest rates were negative for most of the last 15 years. That has never before happened in history. Normally, money costs something. There's a cost to money. I'm not just talking about the nominal interest rate. I'm talking about the nominal interest rate minus inflation. That's usually positive. But for most of the last 15 years, it's been negative.
Which is why you love the Federal Reserve so much. That's right.
It didn't happen by Didn't happen by osmosis, Todd. It
Yeah.
was the direct repression of interest rates by counterfeiting money, printing a tremendous amount of Fed credit, handing it to banks. Banks take that credit and they buy more of what the Federal Reserve is going to buy the next go around, which was mortgage-backed securities and bonds. That's what they bought. And when you buy those bonds, they go up in price and the yield goes down. And when money becomes virtually free and profoundly negative in real terms, Wall Street goes amok. Like Blackstone will take that money, borrow it, and buy huge tracts of single family homes. And that's one of the reasons why we still have this immense housing bubble, which is in the process of faltering, in my opinion.
Well, let's talk about that. I mean, do you think we are headed for, you didn't really say what your fear was for the economy right now, but I mean, is a housing crash imminent?
Well, let me just tell you what my fear is. My fear is we have a triumvirate of asset bubbles that exist concurrently for the first time in history. So that's a potential problem, and which makes that problem kinetic is when you have liquidity draining from the system. So you have, like I mentioned, the level of real interest rates profoundly positive, the reverse repo facility, which was once $2.3 trillion, is now practically almost zero. It's like I think there's like $100 billion left in the reverse repo facility. The Treasury General account is being drained. It was once 800 billion. Now there's about 300 billion left. So bank lending standards are tightening. So liquidity is being drained. Taxes are going higher. Tariffs are taxes. According to some estimations, they're the largest tax increase since 1981. The border is being closed, thank God. But in short term, a reduced labor force, deportations and border closures on a second derivative basis means that there's less people coming into the labor force, which is 1/2 of GDP growth. If you look at the Department of Government Efficiency slashing government spending, by some estimates, government employment was 70% of all hiring under the Biden administration. If you look at direct government hiring and the ancillary effects of government suppliers, government contractors. So that's ending. So if you have GDP shrinking, not according to Michael Pinto, but according to the Atlanta Fed, Q1 GDP is supposed to be minus 2.4%. So you have government shrinking and liquidity drying up. You have the economy shrinking, the labor force shrinking, and the fuel behind these asset bubbles is cut off. So, yeah, I'm concerned. So should you.
So maybe to the point that they could all implode at the same time.
Well, home prices are definitely rolling over. I one of my houses here is in Naples, Florida. This is where you're recording me from. When I first moved here at the COVID wave in 2022, there were 3 houses available in a community that has 1,200 doors. And now there's something like, I think it's 40 or 50 homes for sale. And every day there's reductions in the asking price for the homes that are listed every day. So the prices here are already down some 15%. And I think they have a lot, potentially further to go. Maybe as high as 20, 25%.
So Michael, I'm a real estate broker, and I hear everything you're saying, and I've been tracking. Obviously, it's part of my livelihood to track the housing market, and someone that has gone through the 2008 housing crash. I fully understand that there really is no reverse gear. I mean, the U.S. housing market is really the sort of like the pulse and driver of a lot of GDP. Depending on if you add up all of the housing related services and costs, the housing industry may represent maybe 30-35% easily of GDP. And so what happens, like we witnessed in '08, is when the asset prices start to fall, it really throws a wrench in everything, because that affects the banks, that affects the homeowner's ability to keep this thing going, whether it's hiring service providers or just throwing in the keys to their house. Do you think we're looking at another 2008? Do you think, even though, people would argue and say that was driven by subprime, the liar loans and do you think that we could find ourselves, since we watched in a lot of cases home prices double in 5 short years? I mean, do you think that this is just the beginning to a massive housing crash?
Well, that's true that the underwriting standards are better this time around, but I don't take much solace in that because things like FHA loans, FHA secure loans, they're up 1,000% since the global financial crisis. When you put 3.5% down, and the default rates are surging there. But here's where how I think about this, Todd. So year after year, especially after COVID, the amount of homes purchased by investors were anywhere between 20 and 25%. And one quarter was as high as like 60% of single family homes purchased by investors. Again, that's a derivative of money being virtually free. I mean, why, if a mortgage was 3%, and it was sometime post COVID, and home prices are going up 20% a year, and you could rent it out and get a nice, strong, positive cash flow, and you could, your money's costing you 3%, but your home price is going up 20%, and you get that positive cash flow. Doesn't it make sense to like take out a bunch of loans and buy a lot of houses? Well, that that idea isn't unique to a certain, unique group of people. It was replete throughout this country, and especially on Wall Street. But that calculation has changed because now you're seeing the unemployment rate rise, it's beginning to tick higher. I think it can go much higher than it is here. So that's going to cause a crimp in your cash flow because your renter might not pay you. And then let's just take it to the mom and pop who owns like 4 or 5 houses on the side, which I know many people who do. Many, many people in the top quintile of their earners have multiple properties. And they say this is the calculation. Well, I'm up 100% on my 3 houses that I bought post-COVID. And now those home prices are starting to flatten out and roll over. And I'm paying an exorbitant fee on, the taxes and the maintenance, and the insurance is killing me. So it's no longer a good investment. And my renter is not paying me anymore because him or her lost his job. So it's not like you go, oh, geez, do I really want to move? Do I want to change all my addresses? Do I want to call a moving van? Do I want to do, do I have to pack my whole house? No, you just call the real estate broker and say, hey, dump these properties. It's so simple. And I think that process is just, it's incipient at the moment. It's going to snowball. So, yeah, the underwriting standards are better, but the quality of home ownership is terrible because it's not owner-occupied homes. It's not owner-occupied that I was a renter, now I own the home, but I had no business telling you I had a job when I don't, and I didn't put any money down, so now I'm going to sell my home. It's the calculation I just mentioned. I am an investor with multiple properties, and if I'm Blackstone, I have thousands of properties, and I'm selling them. So yeah, could it be something very close to what we had in the global financial crisis? Yes, it can. And when you add to that the bubble in credit and in the market, yeah, there's every reason to believe it could be a loss of 30. I think it was 33% that the Case-Shiller home price index dropped in the global financial crisis, down 33%.
And the crazy part about that, Michael, is that wouldn't even get you back to pre-COVID prices. I mean, that's the ridiculous part of that, right? And these houses were priced at, right now they're still priced at 2 and 3 handles. And I just want to go back just quickly on a couple things. You had said that you really weren't convinced that we're not in the same spot as we were in the subprime because FHA is the new subprime lender. Is that what you were really getting at here?
Yes.
Yeah. And I completely agree. I mean, and what we've seen with their, the modifications, and now the sell-off that we're seeing from Fannie Mae and Freddie Mac, and the sell-off of these bundles of NPLs, non-performing loans, and reperforming loans. I mean, it's almost. I mean, it's becoming like pandemic in nature as well. I mean, and we're not seeing the foreclosures. So a lot of people are like, well, everybody must be doing well because there aren't the foreclosures that we saw back then. Do you 100% blame the Federal Reserve for this, the allowance of, the suppression of interest rates and buying these mortgage-backed securities? I mean, I'm sure it was done. Obviously, it started the government or the Federal Reserve buying mortgage-backed securities was really a post-result of the GFC, because that's when they really started. I think it was 2011 or 2012, something like that. Do you blame them for the fact that these home prices have skyrocketed, doubled in a lot of cases, allowed, some counties and cities in Texas, over 50% of the homes in the sales in these certain counties and cities were investors? I mean, do you put that blame solely on the Federal Reserve, or who really is behind it?
Well, yeah, I do. It starts with our central bank, and when they make money virtually free and negative in real terms, then you have Wall Street and shadow banks, which jump on board and do what their behavior says to do. They're greedy, greed and opportunity, and that's to me, it's very simple. And you have to ask yourself, I have two things I want to say. Is one is why do we even have a central bank doing such a thing? Well, it starts with the government. It starts with the Treasury. So when the Treasury runs these massive deficits and runs up $36 trillion in national debt, which is now 720% of our revenue, you start to get a fear in the bond market. And if the Fed wasn't expanding its balance sheet and buying and just being this deaf, dumb, and blind buyer, price insensitive buyer of our debt with an unlimited balance sheet, then yields on the Treasury would be subject to the supply of savings in the country and globally. And if that was the case, then yields would be much, much higher. And that would render the nation insolvent. We already have $1 trillion in interest payments on our debt. If you look at mandatory spending, entitlement spending, defense spending, and interest, it's more than our revenue. And if you look at the assets, the total assets of the United States, minus our unfunded liabilities, we're insolvent. It's an insolvent nation. So the Fed, I guess, if you love Jerome Powell and you love the Federal Reserve, you can say, well, they really have no choice because they have to go. There has to be a buyer of last resort of our government debt. They don't do it directly because it's illegal just to participate in auctions directly. So they use the banking system, the primary dealers as a conduit. Here's some credit. Here's some bank credit, which is part of high-powered money. It's part of the base money supply. It's used to buy bonds, and then the banks go and buy government debt. So that's the truth. Now, you might not like to hear it. Maybe you do. But CNBS doesn't like to hear that because it's scary, but that's a fact. Not my opinion, fact.
I think right now, what I just heard Jamie Dimon a couple days ago in an interview. He said when he was directly asked, "Do you think we're going to see a recession?" Of course, we could talk. He defined what a real recession is, but really, when it got down to brass tacks and he was pushed, he said that he would expect that we were going to have a lot more debt collapse, that we were going to see, people defaulting. And of course, he described that JP Morgan Chase would be fine. Of course. I mean, no one wants to talk about a self-fulfilling prophecy. I've interviewed bank CEOs before, and and then months after the interview, we find out, geez, what they said wasn't so. And I get it. Jerome Powell can't come out and say we've got a banking crisis. It's going to cause a massive banking crisis. So it becomes that self-fulfilled prophecy. But hearing Jamie Dimon say that they are one of the biggest banks in the world, not the biggest, but that they are doing steps to prepare for a massive slowdown, and whether it's a reduction in staff or programs that they don't need to spend money on. But when we look at this, can you tell us, Michael, what are the implications? So we start with a housing market, and we'll get to the stock market because I want to ask your opinion on that, the Magnificent Seven. And but when we're talking about the housing market as really the backbone of America's economy, people being able to afford to live, we really screwed this up, in my opinion. I won't say we as in maybe me included in that, but I'm saying the Federal Reserve should have raised interest rates a long time ago. We agree to that. But now we have an unaffordability situation on our hands, potential default. We know that there are just millions of people that have been bailed out in modifications. They're still struggling. What kind of implication does a collapsing housing market or home prices falling due to the bond market? And, what does that, I mean, we're hearing U.S. Treasuries in the news a lot. China's threatening to sell off their U.S. Treasuries. What does this, so we're looking at this everything bubble. How dangerous is it? And where are we sort of in that mix of the chaos right now of something like that actually happening?
Okay.
Loaded question.
That's a lot. That's a lot to unpack, as they say. So let's unpack it. So first of all, if I'm correct, and home prices are going to drop in that neighborhood, 25-30%, especially in the Sun Belt and North Carolina, Texas, and Florida, where everybody moved to, and all the banks are lending to, that's gonna render a lot of banks insolvent, in my opinion. So there's gonna be another banking bailout. And don't forget, banks are not only exposed to mortgage-backed securities, they also own a lot of treasury debt. Shadow banks own a lot of treasury debt. Collateralized loan obligations, which are leveraged loans. There's private credit in there too. So we have the most leveraged system ever. So I can't imagine we're talking about the stock market in a little bit. If there's a problem in the debt markets and the credit markets and in real estate and in stocks, I can't imagine there's going to be a lot of banks out there healthy and making loans because they won't have any capital. So, so we're going to have another banking bailout, in my opinion. So let's just talk about treasuries. You mentioned treasuries before. So treasury prices are a function of two things, especially on the long end of the yield curve. The short end of the yield curve is a function of whatever the Fed funds rate is, the money markets. So if you think about T-bills compete with the Fed funds rate. So the Federal Reserve controls that rate. What they really don't control is the long end of the bond market. And that's mostly concerned with insolvency and inflation. Those are two primary concerns. And as I mentioned before, we are, in my opinion, and actually, if you do simple math, we are insolvent and we have a huge problem with inflation. The tariffs are exacerbating that problem. So let's just talk about inflation for a second. Inflation has been above the Fed's, as I'm fond to say, 2% target for 4 years now. Now, why would our central bank, which is put in its charge to reach its 2% inflation target? It's really in 1913, it was stable prices, but stable prices have been redefined somehow to be 2%. But the way they calculate inflation has been above 2% for 4 years. By their own projections, inflation won't be back to 2% for a total of 6 years. And yet our Fed is in the process of a rate cutting cycle. Does that make any sense to anybody? Why would you be cutting rates? If you're above your target, well, shouldn't you be raising rates? But this is a Federal Reserve that was buying mortgage-backed securities, was doing QE as late as the spring of 2022. So it's not really shocking. But okay, so back to treasuries. So it's not just insolvency and inflation that the treasuries are concerned about. Let's look at China. So, and these tariffs. So, I'm by the way, I'm gonna couch these comments in the context that I am a libertarian. I'm not a Republican. I'm not a Democrat. I did vote for Donald Trump. I don't think he's Ron Paul. He's not even Rand Paul. He's not an Austrian economist, but he's far better than the alternative, in my opinion. Hate me or not, I want you to know how I feel. I voted for the man, and I think he's infinitely better than Kamala Harris would have been. Okay. So now, having said that, Trump puts tariffs on. Tariffs are taxes. Okay, that's exacerbating the inflation problem. But here's the problem when it comes to treasuries, not only insolvency or inflation. So what tariffs are doing are going to dramatically lower the amount of global trade. Global trade is thus right now. China sends us hundreds of billions of dollars a year, hundreds of billions of dollars worth of goods. In exchange, they get dollars for those goods. So China gets dollars. We get cheap toys and electronics. And China has been in the habit of recycling that or just placing those dollars into our treasury market and into our equity market. If global trade were to shrink significantly, there would be a lot less of those dollars that need to be recycled into our bond market. That's one thing. The other thing is that China and Russia and any of our enemies have seen what happens when there's a conflagration between the United States and other countries. The United States can capriciously and arbitrarily just cut you off, just freeze your assets. So I think China is a seller of our debt, at least on the margin, and that's how prices move on the margin. And the evidence of that can be seen in the dollar and gold, because what I think China is doing now is they're stopping to buy our treasuries. There's much less demand for our treasuries if trade attenuates. And then what they're doing with those dollars that they're selling, they sell a treasuries denominated in dollars. They take those dollars and they're buying gold. So that would lead to a fall in the bond price, a rise in yields, a fall in the dollar, and an increase in the gold price. And that's exactly the dynamic we're seeing. Same thing with Japan. Japan is the largest buyer and holder of U.S. debt. If you look at the Japanese 10-year bond note yield, in the fall of 2022, it was 22 basis points. It was under 0.25%, Todd. Today, it's like close to 1.5%. So now Japan is saying, well, wait a second. Even though they're our friends, and though they're high on the list for tariffs because of the trade surplus they have in the United States. So Japan is saying, guess what? What I'm going to do is I'm going to instead buying your treasuries. I now have an alternative in my domestic market. So domestic Chinese investors now can buy JGBs, Japanese government bonds, instead of treasuries. So this is a picture of waning demand for U.S. debt. And you couple that with the massive debt and deficits and the inflation problems, and you have potential for spiking bond yields. That is not, Todd, what usually happens in a recession. In a recession, part of the amelioration process bringing us out of a recession is when the Fed drops rates. They drop the Fed funds rate, which drags lower T-bills because they compete in the money markets. And then a recession brings buyers into the long end of the bond market for safety. That's the normal dynamic. And that those lower borrowing costs help. They act as a salve to boost asset prices after a while. Not right away, but they boost the economy and asset prices after a while. This time around, you might not see anything like that. You could potentially see much higher interest rates because of the dynamic I just explained. which would cut off that ballast of falling interest rates and from lower borrowing costs. That's the real danger.
Yeah, this is. Has this ever happened? Has it ever happened before? I mean, have we ever seen where a major buyer of our treasuries, like China, decides to buy something like JGBs and gold versus buying U.S. treasuries, which would maybe send a signal through other countries to sort of do the same? I mean, have we ever witnessed something like that?
Well, we had the stagflation of the mid 70s and early up to the early 80s, but there's nothing been like this before. We had so much foreign ownership in our debt markets that could be cut off and sold. No, never before. Not to my knowledge. No. So it's a dangerous cocktail, which would be stagflation, higher bond yields, lower bond prices, lower falling housing prices, crumbling banking system, and the Fed that can't lower rates because they said, well, we don't know how to, tariffs might not be temporary. I think you can go bankrupt betting on the foresight of the Federal Reserve and how omniscient they've turned out to be in regards to the economy, inflation, and the direction of interest rates. So the Fed is not ready to proactively get ahead of this issue. And even if they did, even if they said, you know what, forget about it. I don't care. I am now going to aggressively cut interest rates because I'm worried about another repo crisis, another freeze in commercial paper lending, for example. Even if they did, that would, in my mind, serve to only exacerbate the problem with inflation and lose further confidence in the long end of the bond market. I mean, just think about if the Fed's balance sheet was $800 billion prior to the global financial crisis. It shot up to a little bit over $9 trillion of money printing. And the Fed has managed to get it back down all the way to 6.7 trillion. Now, 6.7 trillion is much higher than 800 billion. And imagine if they had to right now, start expanding its balance sheet aggressively. I think that would be a tremendous damage done to the dollar and to the confidence in our bond market.
So we're really backed into a corner. So I guess before we, I know, I do want to talk just briefly on your thoughts of the stock market, but staying in the same spirit of what we're talking about right now, a lot of people are going to be quick to blame this current administration of any downturn. Is what you're describing with the tariffs exacerbating the situation, or is this actually something that needs to happen to get us back into some type of equilibrium? And along with that, people that would be quick to judge, to say that, if we have a downturn right now, we have a falling housing market or anything happen, this is this president, his fault and his administration's fault. Is this just a result? And I'm not even really looking at the Biden administration, but for many different administrations over the last 15 years, is this all sort of like just coming to a final head?
Yes. So Donald Trump will most likely be blamed for intensifying and exacerbating the decline, but the decline has been set up since 1987, in my opinion. When we had the collapse of in October, we had the Black Monday and Greenspan bailed out the financial system, and that process has been inculcated through decades. It's not something that's just happening now. It's through decades. Goes from Greenspan to Bernanke to Yellen to Powell. They've just all piled onto this idea where the Fed used to be at 1913 in its initial construction. It was the lender of last resort. So you would have to go, as you as an institution, as a bank, certain banks, not all banks, not the shadow bank, you could take your treasury assets, not corporate debt, not mortgage-backed securities. You would take your assets to the discount window, and the discount window would loan you money, credit, at a discount to what your distressed assets already were. That's it. But that somehow metastasized and morphed into, hey, we have this thing called the fiat currency. why do we worry about recessions or maybe a bear market? Do we really need those things? We could just monetize or print them away. And that's what's happened. That's called a Fed put. Now, that's again, not my opinion, Todd. The market believes through years and decades of inculcation that the Fed put is real, that the Fed will come to the rescue at the slightest glimpse of a stock market that's, even close to a bear market. Not even 20, bear market's 20%. So even if it goes down 10%, that's the Fed's going to ride to the rescue. And I have my doubts because this time around, not only is the Fed going to be reticent to do that, as I mentioned, because of inflation, but the bond market could be in full revolt, and they know that. They got to be very careful. I still think when push comes to shove, because when the credit markets freeze, Todd, there's really nothing the Fed can't. There's no other option for the Fed. They have to monetize the system immediately because, that's how companies make payroll. They float commercial paper. I mean, the overnight lending is the money markets are the functionality of the banking system, the shadow banking system, corporation. It all exists on the proper greasing and oiling of money markets. When they freeze, you're talking about a depression on steroids. You're not talking about a slow glide down. So it's a depression on steroids. They have to do it. And especially given how financialized the system has become and how massive these asset bubbles were concurrently, it guarantees the destruction is going to be enormous. So they will assent to QE and ZIRP, zero interest rate policies again, but it'll be ex post, not ex ante.
Listening to you talk about this, I mean, I'm thinking two things are coming into my brain. One is that we need a massive correction that should be or could be very painful, but essential for our, for the American people moving forward, the generations to come. And a lot of young people feel like they've been robbed by, the prior generation, the baby boomers specifically, in saying that, they had it all and they robbed from our future. I mean, we hear that a lot, especially when they can't afford to buy a home today. But the other thing is that the setup for almost like a universal basic income, because, they're going to get to a point where they're saying, okay, we can bail out the system. We can bail out these people, but that doesn't mean that these corporations are going to be able to pay higher salaries for people to be able to afford the inflation. So the whole thing to me seems like a whole house of cards and quite scary. Michael, let's sort of wind down with the stock market. What I'm really concerned about is the Magnificent Seven that seems to be over the last several years the only, thing that's kind of holding the markets together. They're always talking about these Magnificent Sevens. We're in a situation where the stock market is, it's so out of whack with the amount of with the stock cost versus the earnings or the company's ability to ever make enough money to satisfy the investors. And that's why most people don't do very well in the stock market. The top tier income earners or investors seem to be holding all of the wealth there. But what are the risks right now with this system coming crashing down, and how does AI play a part of that?
Okay, so the top 1% of earners have more wealth than the entire middle class, which is the 20% to 80% of earners. That has never happened before in history, and that's not a function of free market capitalism. And I forget the exact data point. I believe it's 50% of all households don't have $500 in the bank.
It's pretty bad.
It's just this is the hollowing out, the destruction of the middle class, which at least Trump has a noble effort of he identifies the problem and wanted to fix it. His implementation has been disastrous. I'm not going to defend him for that. I'm saying that for him to want to rebuild the manufacturing base and to balance our trade and to rebuild the factories and the middle class. This is all noble, great. These are wonderful efforts. But I think he should have started with the Federal Reserve. You know, you know, um, people who own multiple houses and have a huge stock portfolio, they benefit primarily from asset bubbles. The lower classes don't do that. And they're the most impacted by inflation. So the stock market bubble was engendered by this phenomenon, this automatic funding of 401k plans, this passive investment. You have a job and you fund your 401k. Don't forget, after decade after decade, you've been inculcated, hey, just buy stocks, buy the S&P. Well, those passive flows into the S&P went into it's a market cap based index. So the highest market cap stocks get more and more of the assets. It's not something you consciously do. It's something that happens automatically. And then these 7 stocks become, 40% of the S&P 500. And that's a process that once you get rising unemployment rate and people no longer are funding their 401k because there's just less people doing so. And then when the market starts to fall precipitously, and then the people who do have a job call up their plan administrator and say, put me into cash, get me out of the S&P 500. The headline indexes don't just fall gradually and gracefully, they crash. And that's exactly what happened already. You see it already. And I don't think it's anywhere close to being over. Because I said, even if Trump went back and said, all tariffs are canceled, we're just going to go to a 10% flat rate on everything. And there's going to be no carve-outs, exemptions. It's just 10% flat rate for everything. Even China, the process that I mentioned before of the asset bubbles conflicting with this liquidity draw, it's going to happen sooner rather than later. It was pulled forward by what these tariffs have done. So we're going to have, I believe in the reconciliation of asset prices. Mean reversion is another thing I believe. Home prices have to revert because, listen, there's no way you can have a housing market stay where it is when you have first-time home buyers priced out of the market. They just can't afford a house. And if the first-time home buyer can't afford his house, then the person who's selling that house can't move up. So it's a cycle it's doomed. It has to correct. Home prices have to correct by 30 to 40%. Equity prices have to correct by 50% just to put them back into historical normal metrics. So that would be devastating for the banking system, obviously. So the Fed is going to come in and try to truncate that process. But when they do, they're going to create massive inflation, and the process is going to be highly stochastic. And if you don't own an active management strategy where you could sell these bubbles and then buy them on the nadir or close to it, or at least try to do that, I'm afraid you're going to go nowhere in the next decade, because the average return based on valuations right now is around 1%. That's the average return per annum. And it's not going to be linear. It's not going to be 1% every year. It's going to be maybe 1%, 5%, and then down 50, and then work your way back up, which equals to a 1% amortized rate, but of return. So active management is the way to go.
So, Michael, what do you offer that can help people if they're, trying to navigate this uncertainty right now? I mean, it's, whether you're, trying to protect your wealth, wondering, the problem with people nowadays, especially Gen Xers and baby boomers, they're wondering, is this going to impact whether they can afford to live out the rest of their life? I mean, if they have any type of major financial crash, these are the people that, and I'm not talking about the top 1%, I'm talking about the ones that are depending on their retirement accounts, that are depending on their Social Security, depending on their stock accounts to, provide them with a dividend. They don't necessarily have the time to go through a 10-year cycle or downturn. So you have that subset. And then you also have the young people that are trying to make ends meet, that can't afford, to buy houses right now, but still have some cash, still looking for, ways that they can invest and build and grow, take advantage of any potential downturns. Can you help these people?
Well, I said, it doesn't have to be me. I am an active manager, but it doesn't have to be me. But find someone who's who's knowledgeable, who's honest, and who has a robust model. And there's not many out there because most of Wall Street most of Wall Street are salespeople. So what they'll do is they'll take your money and then they'll go to the golf course and try to raise more money, and they'll just you'll plug your investments into something that mirrors the S&P 500 with maybe some bond exposure depending on your age. I can do three, if that's the case, I could say buy SPY for this S&P 500, buy EEM for emerging markets, foreign stocks, and buy TLT for bonds. Those 3 ETFs, and then you don't need to pay a money manager to manage your money. But if you're actually someone who cares about, I'm in retirement or I'm approaching retirement and I can't afford to lose 50% because then I need 100% to get even. And it does come back usually in about 6 years, but I don't have 6 years just to get back to even. I need to make money, or at least try to make money every year, at least preserve my capital. And sometimes it doesn't come back. For instance, Japan peaked in 89 and it's still not back. And China, Shanghai index peaked in 2007 and it's still down like 40%. So I can't wait and hope. I need an active manager who's experienced, honest, hardworking, and can model the economy so I don't have to lose this money. That's my best advice for you. Doesn't have to be me, but someone.
Well, appreciate your honesty on that.
He's not going to tell you buy and hold. It always comes back, because that's what Wall Street, that is, especially people who've been in the business knew. That's all they know, is that the administration, the government, the central bank has your back, and they will not let stock prices fall.
Michael Pento, I thank you so much for your time, and we've published all of your information in the show notes below. I encourage you, follow Michael. He has a podcast, he has a newsletter that you can sign up for. So, sir, I hope we can get you back on the show sometime in the near future to watch as this thing unfolds.
Appreciate our time together, Todd. Thank you.
Talk to you soon. Thanks so much for watching. If you liked the video, you can let us know by smashing that thumbs up. And if you haven't already subscribed to our channel, please consider doing so now. Hit that alert bell. You'll know every time we upload content just like this. Keep those comments and questions coming. And one of the biggest compliments you can do for us all here at Sachs Realty is to share our channel and this video with your family and friends. This will help us to continue to build this amazing online community with viewers just like yourself. See you next time. Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.